working a ton of hours and, 80, 90 hours a week. And so, 15-hour shifts, 18-hour shifts, 30 days without a day off kind of thing. And, we were extremely understaffed. We had wage, worker issues and stuff like that. So I was picking up hours left and right. And
this content is sponsored by Neos Investments, which is for educational and informational purposes only and not financial advice. Investors, welcome a very special guest. We have Chris from Blossom. Now, if you guys want to see both Chris and I's portfolio, you guys can for completely free on the Blossom app, which will be in the link in the description of this video, as well as on the pinned comment section to see our portfolio, our buys, and so much more. Now, Chris is a 33-year-old hybrid investor who started with $0 in his portfolio and has now built himself a nice 6-figure ETF-only portfolio to achieve his goal of financial freedom. Chris's top 3 ETFs in his portfolio are VOO by a very wide margin, VYM, and VGT, where his top 3 cover call ETF products are going to be GPIQ, GPIX, as well as QQQI by Neos. And another fun fact about Chris is that his portfolio has a dividend yield of just over 2%. And with that, I want to welcome Chris to the channel.
Hey, great to be here. Big fan of the channel.
First question for you, Chris, is can you walk me through your investing journey from the beginning up until now, and what first got you to invest in the first place?
I started kind of been in fast food for a long time. And so I didn't learn about, obviously they don't teach investing in high school, and I didn't learn anything from my parents. And so once I started working at my job, the only type of investing that I had was through my 401k, which is, it's kind of just a set it and forget it. They do all the allocation for you. It's really not investing. You just talk about how much you want to put away, and then they'll match it. So thankfully I do have a match, but I wouldn't really call that investing, just because it's not really investing. It's everything's handled by the company. I just tell them how much I want to save, and they handle everything for me, and I can have a snapshot of it, but I can't really do anything. But during the pandemic in 2020, there was a lot of new investors getting in, and so there was a lot of YouTube content showing up about that and about investing, particularly with Robinhood. And so I saw something on actually TV that said, sign up for Stash today, and you can start investing with as little as $5. So I'm like, okay, great. So I put some money into Stash, and as I started to learn, I was probably only in there for maybe a month or two. And then I switched over to Robinhood because that's where all the hype was in 2020 and 2021. And so I was on Robinhood for quite a while. I was loving it. I was starting to buy. VOO was the first thing that I bought. And then I started to buy some individual companies. I had Walmart, PepsiCo, Coca-Cola, Home Depot. And then I started to really learn more about ETFs at that point. I was watching content from the Money Guy show, and then also Dividend Diplomats, which I still follow every now and then, and they're not getting into like the covered call craze. They're kind of just staying with their own dividend stuff, buying SCHD and VYM. And so as I started to follow those things, I started, slowly selling down the individual companies that I had. I thought it was too risky. I wanted to kind of just have more baskets of stocks, and I sold everything kind of in 2021 and 2022. I think I had Walmart left at that point. That was all done on Robinhood. And then I was kind of mostly on ETFs. But then the state of Massachusetts, which is where I'm from, was talking about taking away the license for Robinhood because of the kind of the gamification setup that Robinhood kind of provided, where you would make a trade and it would, have balloons and party things and stuff like that. And the state of Massachusetts did not like it. And so they were talking about, oh, maybe we're going to not allow people to use Robinhood. And so that kind of scared me. I'm like, well, I have my money in here. What happens if Robinhood goes away? And so at that point, I switched over to Webull, which was kind of a newer one. It's very popular. And then I was on there for a couple years. And in 2023, I switched to Fidelity, and that's kind of been my permanent home. It's a little bit more kind of grown up, and so there's more to learn about it. But now that I've kind of been investing for a while, and I've kind of grown up more on investing and kind of watched a lot more YouTube content and just kind of done my own research. I love Fidelity, and I'll probably never leave Fidelity.
So looking at your portfolio, you have VOO, VYM, VGT, DGRO, and then a fleet of cover call ETF products. Some other YouTubers and investors are still sticking with the traditional way of investing in dividends, which is like SCHD, dividend stocks, and whatnot. But you said that they aren't going towards cover call ETFs. So do you think that they're missing out on, I guess, more yields or even just better returns because some cover call ETFs that you own, GPIQ, GPIX, QDEVO, QQQI by Neos, have outperformed dividend ETFs like VYM, SCHD, and whatnot?
I would say that over the last few years, these covered calls, because of how well the Nasdaq has been doing, particularly the Nasdaq funds and crypto, they've really outperformed things like dividends. And so I've taken the time to kind of trim down. Up until a couple months ago, I owned SCHD. I think it was about 300 to 400 shares of SCHD because they did, I think it was last year, they did the stock split. And so I had a certain amount of shares and then I got 4 times the amount of shares. And so I started selling that down because SCHD was actually in my entire portfolio. It was the underperformer out of everything, including the covered calls that I had. And so I kept a little bit of what I sold out of that for cash. And then I put the rest into the covered calls. And I still own VYM and DGRO, and I use those more for kind of stability and dividend growth because a lot of these covered calls, you're sacrificing things like the upside and kind of the annual dividend growth that you get from traditional dividend stocks and ETFs. Covered calls have definitely done better. There's no way to say like if that will continue over the next 10 years, maybe. The Nasdaq doesn't do as good because it's run so much, and maybe VYM and SCHD outperform. And so, but definitely, so I'm definitely keeping VYM and DGRO. I have no plans to sell them, but I'm really not adding to them right now. I'm trying to grow the covered calls right now because I'm more new into the kind of covered call space. Got into that more last year. Started to buy.
You said that you started with $0 in your portfolio and built over $130,000 in your portfolio, which is amazing. And you said that you also work in fast food. So is that a hard feat because of, like wages or whatnot and how expensive it is to live in America? And how long did it take you to achieve $0 up to over 6 figures in your portfolio?
It is hard, definitely, especially in the state of Massachusetts. Is very kind of high cost of living, not the highest. Like New York, California, I've heard stories about kind of how it is out there, but it's definitely up there on the list. There's a lot of cheaper places to be, and so fast food, I think, is one of those kind of things where workers are underpaid and they are definitely not underworked, especially in that space. It's very kind of physical and hands-on and demanding. And so, particularly in my 20s, when I was working and really starting to save, before I was investing, I was, working a ton of hours and, 80, 90 hours a week. And so, 15-hour shifts, 18-hour shifts, 30 days without a day off kind of thing. And, we were extremely understaffed. We had wage, worker issues and stuff like that. So I was picking up hours left and right. And so while I was working that many hours, I didn't have time to spend anything. So I was just working. So the money kind of sat in a savings account until I started my investing journey in 2020. And then at that point, I did put some lump sum in there, about, I think it was maybe 25K. It was a lot of what was in my savings account because now I had a place to put that savings because the savings, it wasn't making any money, especially after with inflation really ran up after I started investing. And so it was probably good that I found a new home for that. But it takes a lot of sacrifice. You have to save a lot of money or go out and get a side hustle. I also do DoorDash, which was funding my investments. So, and it's just really about, it's not always about how much you make. It's sometimes about how much you save, but certainly on people that are making a lower income, I think it is a lot harder to save and also to be motivated to put money away, especially with the cost of living.
I want to ask, like, how many hours a week do you work? And so you use your main job as a manager to
Right.
live? And then was it the DoorDash money for investments? And fun fact for people who don't know this about me is before I worked in finance, I actually worked at Domino's Pizza. I was a Domino's Pizza delivery driver. So I have so much respect for people who work in any sort of fast food industry.
While I was kind of doing that, doing the saving and doing all the kind of working, again, I wasn't investing at that point. I was kind of going out. It took, again, a lot of sacrifice. I had, a lot of time in my 20s where maybe I didn't do as much stuff. I still had a lot of fun. I had a lot of experiences, took a lot of vacations, but definitely sacrificed some of that for the amount of hours that I was working. And obviously I probably wouldn't have been able to keep it up. But in doing DoorDash, the most that I've ever made, it was, I think it was 68,000. It was in 2020. DoorDash was off the hook. I was still working at Chipotle. I started in 2014 and I'm still there now. Just kind of the regular food service salary. It's definitely hard to save, and again, it takes a lot of commitment. I think people with higher paying jobs may have a little bit of an edge when it comes to saving and investing, but I started investing in 2020, and when I started working at Chipotle, I had $0. I had a really cheap Chevy Impala that I bought for $2,500. My dad helped me pay for it, and so I kind of saved up. Eventually, kind of grew up and started saving, and then as I invested, I continued to save. The stimulus checks that I got during COVID also went all 100% into the investments because I was really committed to investing. And as I continued to see the kind of the portfolio grow, and it invested me even more. And now platforms like Blossom, where I can really kind of track my income and track all the growth kind of year over year instead of having to do it on spreadsheets like I was doing before. It's really helped me to kind of be more kind of just excited and kind of motivated to kind of go in there and try to look at new kind of investing techniques and see what I can do to continue to grow it moving forward.
Tell me what about hybrid investing is so appealing for you, your goals, and your needs? Because for those who don't know, hybrid investing is basically investing for growth and then for dividends. So why do you like hybrid investing, and or what is exactly your investment strategy?
Yeah, so my investment strategy basically is to have kind of a portfolio yield that can, sustain myself without having to, sacrifice kind of income in the future, meaning having the income go down. So right now I'm kind of looking at kind of building up to like a 7 to 10% portfolio yield. I'm holding some cash right now that I'm waiting because I only have about 5 to 7% in covered calls. A lot of that was that I put into GPIQ during the April kind of Liberation Day crash. And so it's doing great right now. And so that was the first time where I thought, covered calls would be kind of fit as a portfolio strategy because I owned NUSI. I think it was in 2021. And then the 2022 bear market hit. I had just a small position, couple shares, just wanted to see it, but it really didn't recover. And I was, a lot of YouTubers and people were talking about NUSI because it had the downside protection on it. But it continued to drop. It was at like $27 a share, and then went to 26 and 24, and I sold out of it, and it continued to drop after that. But it, even coming out of the 2022 bear market, it really had trouble recovering. And so I was pretty skeptical of covered calls. As I see more people kind of with the Blossom kind of social and everything else, seeing more people being transparent and seeing people that have been kind of in these longer, because covered calls they're new. They haven't been around for 100 years like the S&P. And so, what actually happens with them in the future it's a guessing game at this point because a lot of them are new and we haven't had a big kind of, financial crisis or any type of real recession while these covered calls have come out because the market has just run. I have a low kind of position right now, but I have cash on the sidelines, and I'm kind of looking for good opportunities to get into the covered calls because unlike the S&P where, my cost basis is like $354, I think I saw when I checked today. I think, I may never be able to buy in and dollar cost average down. It's just kind of the reality. It's up almost 80%. But I think with covered calls, especially higher yielding ones, they may hit new highs from time to time, but I think a lot of the time you'll be able to dollar cost average down and get in at a better price. I don't think the price will run away and never come back to a buying point just because they are paying distributions and limiting a little bit of the upside. And so I've kind of put on a watch list, and I'm kind of waiting for a good opportunity to increase my exposure to covered calls. I believe in covered calls now to a good extent, and so I'm in covered calls, and I have been since March and April of this year, where I've started to add, and I've continued to add, as you said, I alluded to. But I want my portfolio to be able to sustain. So I have my S&P 500, and VGT, which I want to kind of help the portfolio grow. And then I have kind of my VYM and my DGROW, and that I want to use to help the distributions kind of dividends grow over time, because they've been around for a long time. DGROW's been out for, I think, about 10 years now, VYM even longer, and they just have a great track record of growing the distribution, so I'm not worried about that. And then the covered call is going to be to kind of increase the income and help maybe even fund things like VU, or to just kind of reinvest back into them, or build up kind of a cash position and kind of wait and see maybe there's something with a little bit higher yield that I can kind of sink my teeth into and kind of just start buying. But I primarily have the lower yield ones now, sub 20%, except for blocks. But I think that, when I go to retire, I don't want to see my yield on cost coming way down. I want my distributions to be able to grow, even if it's at a more modest pace than if I were to just have VYM and VGT and VU. But I still want it to be able to grow over time. I don't want to sacrifice kind of dividend growth for if there's a period of time where I can't reinvest, because with a lot of the covered calls, you have to be able to reinvest in order to get dividend growth to kind of keep up with inflation. So it's really kind of about stability, and I'm still kind of evolving my portfolio to something where I can get up to a higher yield and still have my portfolio always hit new highs when the market recovers, and not kind of be a little bit lower or have to kind of sacrifice income to have to just throw money in and reinvest, because obviously there's taxes and fees as well. So
some investors might argue, why not just go all into growth investing? So you have, your VOO, VGT, maybe even throw in triple QM or SCHG there. Or why not just go all in cover calls? Because on Blossom, you've seen younger investors, even people in their 30s, 40s, 50s, just go pile into cover call ETFs. So why not just go all into growth, or even go all into cover calls for your age?
So, I mean, it really fits into kind of what you want to do and kind of what motivates you to invest, because I think that if someone, is watching a ton of content on covered calls and, they don't want anything to do with growth, they want to do covered calls, but then they have kind of people being like, oh, well, growth is better, but they don't want to do growth. They might not invest at all. And obviously in not investing, you're not making anything. So, whereas covered calls, yes, you sacrifice a little bit of the upside. Something like GPIQ has been, making more than 10%, since it's come out for the most part. So I think that, as long as you're investing in something, I think it's better than not investing in anything. And so even if, growth does do a little bit better over the long term, if covered calls is what you want to do, and if that's the only way you're going to invest, it's better just to go into the covered calls. But for me, I'm starting to kind of build the income, because I want to have the option to take advantage of downturns while I don't need the money. So obviously with VU and VYM and stuff like that have a lower dividend yield, VGT especially, if there's a downturn, I want to buy more shares. Yeah, I get a little bit of the quarterly distributions, but I have to put up my own money. And again, on a lower income, it's very hard. I have to go out and kind of sacrifice some of that free time to go ahead and make that extra money that I need, that I can go in and dump it into something like VU, and while it's cheap. Whereas if I have some exposure to the covered calls and I'm generating maybe $100, $200 a month, then I can use some of that money, either if a medical bill comes up or if nothing comes up, I can put it back into the covered calls, especially if I can dollar cost average down on some of them, and I look to see which ones I might be able to dollar cost average down on. And then if the market does go down, I can kind of buy some of the covered calls with some of the cash that I have, and then go in and fund some of the growth that I can use to kind of use for the future. And either with the growth, my plan is to either sell down the growth, pay the taxes, and move it into covered calls when I get a little closer to a time where I think I can be all in on covered calls, or build up covered calls enough to where I can, sell 4 or 5% of the S&P and just kind of add a few thousand, dollars a year of income onto it, where it would come in quarterly. But if I, have my distributions that are monthly and those are kind of covering what I need for my daily life, then, the quarterly could just be a treat, but it's really going to act as kind of the stability so that I can have covered calls. Because for me, I think a lot of these covered calls, they over distribute. And so you have to put a lot of the money back into the fund, especially for total returns. A lot of them, because they're paid out 100% in distributions and the NAV still goes down. If you're taking a lot of those distributions, to me, you're sacrificing the total return of the fund because it's from the distribution. So if you're taking it and not putting it back into the fund, what is the actual total return? So, so that's why I'm staying with the lower yielding covered calls right now, going hybrid. And, I've just started this transformation. And as, I think the market gets a little cheaper and I see more opportunities, I'll start getting things on my watch list. And so that because of, some of the upside that's being kind of neglected on some of these, not too much the ones that I own, but some of them really limit the upside, where I can actually buy them at a lower price and have a chance to go in the green and not have to see that I'm in the red on those, because I don't want my initial dollars to be going in something and then have it kind of decline over time, because that's what's happening, with my car or something else. I buy it and it's a depreciating asset. I don't want my investments to be a depreciating asset. So that's kind of where my hybrid kind of approach comes in, where I can use some of the cash from the distributions to kind of either go in growth or a different fund that I see that, might be undervalued or might be able to kind of dollar cost average down so it can grow during the recovery, or to add to my growth and kind of just balance out my portfolio to, again, a yield that I think I can sustain over the long term and have growth in the portfolio as well.
Tell me about VOO and why you like it so much, because it is your top ETF by a super long mile compared to all your other funds in your portfolio.
VOO I've hold the longest, and it's up the most. But when I look at, that and other stuff that I've owned in the past, like Realty Income, which just was probably the worst investment that I made. And it was another one that was, before covered calls, people would talk about it because it paid monthly and it did grow the dividends at, 4% annually, but it hasn't done anything in years. So I sold out of that, and ultimately, the SCHD as well, after they did the kind of the stock switch up there where they kind of sold and bought new stuff that, really didn't perform well. And they sold the stuff that actually did kind of perform well this year and bought stuff that didn't. So I kind of sold out of that and added a little bit more to VYM. But I think VOO will continue to be the largest holding. I'm not adding to it anymore, but I'm taking the kind of the dividends that I get from that, which isn't very much, and I move it into kind of other areas that I want to have more exposure to. But it feels the safest for me, and that's why I hold it, because it's the S&P. I think, as long as all the companies do good, then, and the biggest companies in the country, they do good, I think VOO is always going to do good. It's lower turnover, and if a company's not doing good, you have 499 other ones, and they just add another one in, and that one can grow and do the same thing. And it's got a lot of, especially recently, it's had more kind of Mag 7 exposure in there, and NASDAQ stuff. So I don't really see the need to own too much of the NASDAQ, because the S&P is kind of coming a little bit more tech heavy and kind of less of a benchmark. But to me, it's the safest. It has the longest history. And I mean, if the S&P fails forever, then money's probably not worth anything at that point either.
Tell me about why GPIQ, GPIX, and then QQI by Neos are your top 3 cover call ETFs out of the 6 that you have.
Yeah, so it started with doing kind of a lot of research, and GPIX and GPIQ, which GPIQ was the first one that I held, which again I bought in April. Between I think it was the end of March I started buying it, and then I think the last share I bought was in April 21st or something, and it's up 18% since then. And so, if you're looking at kind of reinvesting distributions when, only when it's red, then, moving forward, I won't have to until there's a big downturn, because, it only has a 10% yield. Neos, I've seen a lot of stuff on NEOs. I like the way their funds perform, and I've done a lot of kind of screening, different types of screening, to see which ones kind of capture the most upside, especially coming out of, again, the tariffs. There was a lot of big up days, and again, for these covered calls, it's really the only kind of downturn that we've had where it's kind of been significant, like 20% or so. And so there really hasn't been any data to go off of, but I lined up like 20, 30 of them and really kind of looked and see, which one are capturing a lot of the upside, which ones kind of did good, the month after that as well. And so I was looking at things like QDTE and QQQT, I think, from Defiance, and I wasn't super excited about those. Those are ones that I think, if the market's down like 50%, I would buy those. But, things like Misty and, Alti, I think they're too high of a yield. And so I think, even, now both of those are below where the April 8th, tariff lows were, whereas GPIQ, it's up a lot, over 20% it's up. And, even QDTE, I think, is up. And so that's something that I'll take note of and be like, well, if, the market seems like it's really low, the VIX is really high, there's other indicators that show that this could be like a once in a lifetime type of buying opportunity, then QDTE might go in, for sure. But in terms of total returns, QDTE hasn't been doing as good, and definitely the yield max funds, even coming out with the run that we've had, some of them have done reverse splits. That kind of makes me nervous, because if we do, in 2026 or 2027 go and have a negative year, what's going to happen to those funds if they're already doing reverse splits in a bull market? For me, I don't want to own the higher yielding ones. And so that's why I haven't yet, but I think I will own higher yielding ones.
And then what about QDVO? Because that one also is kind of one that people don't look at because of the lower yield, but the upside is pretty good.
Right. So I looked at I'm a big kind of total return guy. And so I looked at the total returns, and that was one that really followed closely to the total return of the NASDAQ. Now, I have noticed on some of the up days that my kind of GPI Q and triple QI have been doing a little better on the upside days. And so I'm watching that closely to see, if that's going to kind of lag and not capture as much of the upside. And so I'm kind of watching that, but it's not doing anything crazy on the downside. But it is one that I think is less popular. But it's one that I recently just got into, and I will add more to it. There was some down days in November, and that's when I added into it. I added it because of the upside, and so I took advantage of that, and I am in the green on it. And so that is one that I'll add to, but I'll do it conservatively, because I do think that right now kind of GPIQ is my favorite one, and I'm waiting for an opportunity to add more. But I'm closer to being able to add more to triple QI, just because my cost base is a little closer to kind of where the price is right now.
I'm going to ask, do you prefer monthly dividend ETFs or weekly dividend ETFs? But weekly payers have typically like a higher yield. Maybe they're taking on more risk than the monthly payers, but do you think that it matters if it pays monthly or weekly, or is it just about the strategy within the fund?
I would say that it's the strategy, but I wouldn't be opposed to buying something that pays weekly if it has a lower yield. I'm having trouble finding, I think if VYM paid weekly or paid monthly, I'd be all over that. Even with the 3% yield, sub 3% yield that's paying, it's like 2.8, I think right now. I would be all over that. It won't, but because of the strategy that it is, sure, I'd love to, get into it, get paid every Friday or Monday or whatever, and see the distributions grow, because it's got like a 6 to 8% dividend growth rate over the long term. It's really about the strategy. And, if I see ones that pay monthly that are going up over time, then I would rather own the monthly ones. But, I think as kind of the, covered call space continues to grow, there will be more weekly payers that will likely pay a lower yield, and maybe even, as you've said in the past, kind of the daily ETFs, I think, will be coming, because now we have the twice weekly and stuff. And so again, it'll be based on the strategy. I think, like a weekly or daily, they get a little harder to manage, just because, they're paid out, very frequently. Whereas, I have kind of my GPIQ, which pays on the first week, QQQI pays on the third week, and QDevo usually pays on the fourth week. And so I'm getting paid almost weekly anyway. I'm looking for ones that pay on the second week, and so that I could, kind of make up my own strategy where I'm getting paid weekly with the monthly covered call ETFs, because for me right now, with the lower yields that the monthlies have, and some of them have been out a little longer, obviously Yield Max is very new. And so some of these, have been out. Goldman Sachs ones have been out a little bit longer, 2023. And so things like kind of JEPI and JEPQ, which I think, for me, I don't own them just because I think there's better options out there now that, they're ones that I definitely were consider owning before because, it had the lower yield, it had some upside, but they're kind of not doing as good as, some of these other ones now. They've kind of perfected it, and maybe, JEPI is what got us started. And, they're like, oh, we can make this better, do this, tweak this. And also I've noticed with the weeklies that the expense ratios, unfortunately, are a lot higher. Whereas, kind of the Goldman Sachs ones are, 0.3% or something like that. Triple QIs 0.68. And so Tap Alphas, I think, right around there as well. And so with the weeklies, though, they're not appealing enough to me right now because you have the higher fees. A lot of them are capping upside a little bit more. And so I think there's an opportunity to own it, but for sure right now I do prefer monthly, just because I'm getting paid almost weekly anyway with the monthlies, and it kind of gives me kind of more diversification, where if I owned a bunch of weeklies and I'm getting paid, 3 funds I'm paying me this day, and then 2 funds might be paying me this day, and then so I'm getting paid all throughout the week, and I can't manage that and keep control of it. Whereas the monthlies I can own, 4 that I love and get paid, every week, and it might fit my strategy a little better that way.
So it seems to me as if you avoid heavy NAV erosion ETFs with yields that are like too good to be true, then the market returns, as well as maybe we could say yield traps, even ETFs that could reverse split. So with that approach, do you think that other investors should implement sort of the similar strategy that you have, with maybe not the same exact ETFs, but with that mindset of, if it's too good to be true of a yield, then maybe it's too good to be true of a yield?
I would say right now, with how well the market has done, definitely, because again, reverse splits are real. They're happening. People have kind of different, opinions on if reverse splits are bad or not, and I don't necessarily think they're bad. I follow Perry over at Blossom, and he talks a lot about the reverse splits, kind of keep his positions from ever going to zero, because as they go down, they go bounce right back up. And so, while I think that's true, I think, in a bad market, I actually think that some of these funds could potentially get delisted, and not because they're going to go to zero, but because investors might flock out of them if they're constantly doing reverse splits. Because if they're doing 1 to 2 now, if we have a 3 or a 5 year market that's really bad, and that can, absolutely happen again, I think, where the market does nothing for a few years and then starts its recovery process, how many reverse splits are they going to be doing? Because, they're doing them in a bull market where the market's up abnormally high, 10, 15, 20%, and the market usually doesn't return, 15 to 20%. And so when you have multiple years in a row, 2023, great, 2024, great, 2025 has been great with a few hiccups, but the reverse splits, I think, eventually people might start to flock out of those. And there was a fund, I was watching, I think it was from SoFi, it was TGIF. It paid weekly, and it had a 1.5% dividend yield. I believe it was from SoFi. And so the ticker was TGIF. It paid every Friday. It was TGIF. And it was kind of a dividend growth strategy, and nobody wanted it. People didn't want it. I believe it got discontinued last year. They delisted it, and there may be other reasons why they delisted it, but I think people just didn't want something that paid weekly that had a 1.5% dividend yield. And the strategy, there might have been some issues with the strategy as well. I don't know if SoFi really has a lot of ETFs, but if people don't want them and there's a liquidity event, people try to launch out of them and move into something safer, whether it be bonds or a different covered call ETF that might be a little safer. I think there's a risk that, some of the worst performing yield max funds, they could be like, well, we're going to focus on these other yield max funds and work on new ones because they have so many. They might delist them, and I don't want to be a part of any fund that gets delisted. And they're kind of run like hedge funds. And I think I saw a post where one of them actually said that these are run like hedge funds, and sometimes they don't always survive the first 5 years or so. And so, like, if we have a bad market, they've only been out a couple years, and I don't want to be a part of them, in that type of environment. Whereas if the market's already down 50%, and I know that the market is, over the next 5 to 10 years is likely going to be higher, then I'll start to add more risk and add some of the higher yields. But right now, I wouldn't be interested in it, but I definitely have some higher yielding ones that are on my watch list, like QDTE.
With your current dividend yield, it's over 2%, but you told me that your goal earlier was to get about 7 to 8% yield. So will you increase your covered call ETFs and cut back on the VOO, VYM, DGRO, even the VGT? Or will you just, like, how will you achieve that goal of a 7 to 8% yield, and which ETFs will you invest more into? And also, like, how long do you think that will take? So is it like a gradual process, or is it like in the next couple of years you want the yield?
Right. So I think, it depends on how the market does. And so because I have cash on the sidelines right now that I'm kind of waiting to increase my covered call exposure because it's so low, I don't plan on selling any of the ETFs I had, like you mentioned, the VOO or DGRO or VYM, because those are the stability. But what my plan is to have kind of the cash that I have now go in when I see opportunities. And then also any new money that I have from working would be going into covered calls. And then possibly also the distributions from VYM, DGRO, which I might actually add more to DGRO because DGRO is pretty low. It's like 4 to 5% of the portfolio, where VYM is like 14. And then, VOO is obviously a lot higher than that. So, but that's just because it's performed so well. And so, it really kind of blew past my SCHD and my VYM, but right now VYM is actually performing better. But I think it will be gradual. I think if, the market crashes, in January, something bad happens, or they don't like the, what's going on in the landscape looking forward, I think I could be all in on the covered calls, and get to my yield then. Or it might be something where it takes more time, where I just kind of slowly add to maybe my GPIX, triple QI, or take a small position in some newer ones, like TDAC, or, some other ones that kind of exist out there.
In terms of retirement, at what age do you plan on retiring? And do you have a specific portfolio value in mind, or how much dividends that you want to earn per year before you say, okay, I'm ready to retire?
Yeah, so I put a lot of thought into this, and actually I recently just got the badge for the 2,500 in annual distributions. So I kind of have that framed up on my wall right now, and so I have a slot kind of for the rest of them all the way up to the last one. I want to increase the distribution yield. I want to it really depends, because, technically, if I went all in on something like Misty or Alti, I can, my income from work is about, take home pay is about 2,500, and it's about, 45K a year. I could have that doubled right now, take 50%, reinvest the other 50%, have 50% cash, and have all the money that I need, maybe even more, maybe 4 or 5K a month. But again, it's too risky. And, we look at something like Misty, it's down to like $8 a share from when it was at 40. I can't believe, I couldn't imagine, being at, buying it when it was all hyped up at, 30, and having it run up to 40, and, it's continuing to do good. Everybody's loving it, and more people are piling into it, and it goes down to $8. Well, that 100, if I put all the money that I have right now, I could have had 130K, that would be over $10,000 a month. But, now if it's $8 a share, I might have $1,000 a month. Oops, got to go back to work. So, I think, that's why the goal is to kind of build up a yield and test yields too. And so as I continue to get older, have a yield that might, again, if the forward outlook looks good, because we've had a period of bad returns, kind of the sequence of return risk, go into something that has and kind of stretch the portfolio yield a little bit. Maybe I can try and see if I can do maybe a 15 or 20% portfolio yield and still have my yield on cost go up. And because, the growth might still be enough to kind of hold the portfolio up at that point, even if I have some higher yielding covered calls. And so I'm hoping, over the next couple years, I can get to, 5K in the distributions, because I think it will happen faster than it has over the last few years, because I did have, VU and VYM and stuff like that where it's such a low distribution yield. You can put money in, you get the dividend growth, but it's quarterly, you reinvest the dividends, it takes a while. Whereas you buy something, like triple QI, you're pulling all that, that future yield on cost that you would get from something like VYM, you're pulling it up and receiving it today. And again, sacrificing kind of the upside and stuff. And so it's kind of like a shortcut, but, again, it's a risky one because it's so new. But I think, somewhere maybe around 400 or 500K with the portfolio yield that makes sense, that I can sustain, would be good, because for someone, in food service, and it's always been in food service for a long time, that, building $1 million portfolio, following Bill Banyan's, 4% rule, which he's kind of bumped that up closer to 5% now. He had an interview with someone and he thinks that, it could be 5% now, but you need to have $1 million to get 40K. And, you still, if you're below in the US, below the retirement age of, 59 and a half, you have to pay those taxes. And so, I have the money that's in my Roth IRA, which is 100% growth, but there's not that much in there. And then I have my 401k through my work. And then I have the kind of the dividend growth portfolio, which is the majority of my money, which is the hybrid kind of approach, where I have a mix of the covered calls and the growth, that I would hope eventually to be able to use and kind of have the distributions to kind of fund some of my daily life, to where I can partially retire and maybe work part-time, and maybe, for my job, it's 30 hours to be able to keep the health insurance and stuff like that. And so if I'm getting, if I'm making 2,500 from my job, but I get, 1,000, 1,500 a month from distributions, well, then I can cut the hours down, still have the health insurance, so I don't have to worry about health insurance. And then I can, work less and have the free time, kind of get some of the free time back that I lost when I was working all those extra hours. But still continue to try to grow the distributions to where I can just fully retire, hopefully early.
And what age does that look like for you to retire early?
45, 50, because I think, as you get, to 60 and, 65, there's less time to be able to do the stuff that you want to do, whether that be because, you have problems with your back, or problems with, your legs or something, and you're spending less money. And so I don't want to kind of fund my portfolio and, have, nothing in my accounts, and kind of just be, retirement rich, where I have all this money in my bank, in my portfolio, but nothing in my bank account. I think if I put too much in there and I have more than I need, then of course I can pass it down. But, and it's a portfolio that's not going to be yield max, that's just all in on yield max. So someone doesn't have to, constantly know how to do all this stuff. It would just be a portfolio that just kind of manages itself. And that's, another part of the goal, is that I want to be able to, not have to manage the portfolio when I do get to the retirement age as much, still go in, look at it because it's fun, investing is great. And so, but not have to go in there and buy and sell and stuff like that, because, I still want to kind of have the traditional set it and forget it, but not have to have $1 million or $2 million portfolio in order to, be able to fund a retirement, because again, on a lower income, it's very hard to save that much money.
What were some of your biggest investing mistakes that you made early on, or even some of your biggest financial mistakes that you made early on that you will always try to avoid?
Hype, definitely hype. So, stuff like specific YouTube channels that kind of just like was in on like penny stocks and stuff. I didn't buy penny stocks, but I bought an electric car company called NEO. And so that one, it went down really low. There was a YouTube that really talked about that. And so, and of course, kind of gambling on, individual stocks is something that I won't want to do. And then also things that I keep in my portfolio too long that aren't performing well, and I hold it for a sentimental reason because I think it's going to do well. Well, where everything else in my portfolio is doing well, like realty income, it did nothing for years. And so, but I held it. And so that money could have gone into something else. Even last year, I could have found GPIQ, put it in there, and GPIQ is up so much from last year. I think, something like that would have been better. So definitely holding funds for too long that don't perform well and then buying on hype just because other people are doing it. And so thankfully I didn't lose a lot of money like on that. I didn't buy the GameStop and the AMC, the meme stuff, and also buying super kind of volatile stuff. So, for when you get to retirement, having stuff that has the 50 to 60% swings that can happen kind of intra-year is not particularly good. And so I probably wouldn't do stuff like that again.
What were some financial habits that you've built along your 20s and your early 30s now that allowed you to build your six-figure ETF portfolio? Is it like avoiding credit card debt, living frugally, working hard, etc.?
Yeah, so it was definitely about, for me, kind of finding where I could pick up some extra income, whether it be a side hustle or, I did filling out surveys at home for a while, stuff like that online. And so for me, it was about where can I get some extra cash and to be able to invest without having to cut out the coffee, without having to cut out the vacations, without having to go back to what I was doing where I was working 80 plus hours, because I just naturally became a saver. It wasn't something that I was particularly like good at or anything that like changed, because again, I had nothing, in my early 20s and through my mid 20s, I had nothing. When I started at my job, I had no money at all. And so I don't know like what clicked for me. It might have just been like from working and seeing kind of money in my account, like, oh, this is nice. And then as you kind of get further and further away from zero, being like, I don't want to go back to zero. And so I think that as I started investing, that's when that was kind of the trigger that really caused me to be a super saver. But before that, I couldn't tell you.
So was there an aha moment for you where you told yourself like, okay, I need to start investing right now? Or did you have like a mentor, father figure, mother figure that told you that you need to invest your money right now for a good retirement one day?
Nope. No one told me about investing, no teachers, no family. And when I did start investing, friends didn't care about it. So they were like, I'm going to the club. See ya. You can tell me about your investing another day. But no, so it was really about kind of just seeing the social media content around investing and seeing the younger people, around investing, and me kind of just trying it out. And again, I tried things. I sold out of some stuff and that I probably shouldn't have, like United Health. It did good for years and years after I sold out of it. And so I wanted to be more conservative, but it was kind of really just seeing, going on to Robinhood and being like, I like this. I want to do more of this. And as I learned kind of more about investing and saw that, I got some growth this year, I want to keep doing this. And then, kind of evolving into the covered calls and say, well, I can grow my, my monthly income a little bit here and there by just putting more money in and, eventually may not have to work. That was kind of the aha moment, is like, if I'm not investing, how do I get out of the rat race? And so if I'm not saving, how do I invest so that I can get out of the rat race? And so the aha moment was really, it's kind of just learning from other people, because actually the community of people that liked investing, because it, unfortunately it is a relatively small community that I think, more people should be doing this, because if you're not investing, it's very hard to retire. A lot of people do have it through their work and stuff, which with the match and stuff, and that's very good. But for the ones that don't, they really should be doing this on their own. And it's never been easier. You can put in $5, $10, $15. And that's what kind of brought me into it, is seeing that I can do this on my own. I don't have to hire anybody. I can just open up an account and kind of have the process made easy for me, which is what Robinhood did for me. And so I was able to go in there and, do some stuff, make some mistakes, and ultimately become a better investor to where I am today now, where went from kind of the individual, stocks and VU to now it's all kind of ETFs. I have no more individual stocks, and now I'm adding covered calls.
Being in the fast food industry, do you have like any, or do you know like any scary like financial stories? Because when I was working at Domino's, I even worked at a PF Chang's for a little while. There were some people who just were probably never going to invest ever, or they had like really bad financial situations that they probably could never crawl themselves out of unless they fix that, or maybe even just start investing a little bit of money for some sort of retirement.
Right. And I think a lot of it is YOLO, kind of you only live once, and, they want to go out and, hang with their friends. They want to go out and travel. They want to, spend everything. And certainly I've definitely, seen people that could have definitely benefited from, putting a little bit aside and not have to kind of sacrifice everything. But sure, I've definitely seen a lot of people that, definitely kind of just they're definitely more negligent with the money, and or maybe just unknowledgeable, because again, a lot of people don't have the father figure. They're not taught in schools, and so a lot of it is kind of just getting people into that right mindset. And sometimes a coworker or something is not enough to get them kind of set up into that, especially when all their friends and stuff are not doing any investing, and they're just kind of out living the paycheck to paycheck, and kind of just making ends meet. And for some people, that's fine. But, I think usually once you get kind of into your 30s, I think, people start to realize, like, I'm getting older. I have stuff that I need to do. I have responsibilities. I live on my own. I have all this stuff. And so I think, a lot of the kind of, financial horror stories is just, people that have, really good setups, whether they're, staying with family, whether they, having help from other people where they can, really start saving, and, so that they can, get their first apartment, or, get their first house or something like that. And, they're choosing to kind of just not do that, neglect it, and kind of just, go blow it all and be like, I'll figure it out later. That's tomorrow me's issue. And so, of course, that was me at one point too. And so, but thankfully, I kind of just figured this out on my own. I got really lucky. I stumbled upon, a video or something like that. I watched it and I was interested by it, and it wasn't any friends or anything like that. And so I think, people just need more kind of knowledge on this stuff, that like, hey, you can put, $10 away. I've definitely talked to people at work that are like, oh, you can buy this. It's got the 100 biggest companies in here, or you can buy this one. It's got, VTI, which I have in my Roth. It's got over 2,000 companies in there, and they're like, ooh, that's scary. But, and it's like, well, and it can be, especially, if you don't know anything about it, like you're putting money in and the market fluctuates a lot. And so it's, for me, it was super scary. I wouldn't touch covered calls. I wouldn't touch other stuff that I didn't understand, because for me, it was scary. I'm like, this is my hard earned money. What if I lose it? But now that I've been kind of in this for a while, I know that like my portfolio has grown so much without me having, to put as much in there now, especially where I've kind of, hit that milestone of having over, the six figures. And so it's kind of growing on its own, and I love it. But it's hard to teach someone that when they're kind of stuck in the YOLO and kind of their own FOMO that's not involved in investing. And if they're just not interested in it, then they're not going to do it. And so, sometimes it's not great to watch, and I'm like, oh, I can help you with this. I can do that. And there's definitely people that I've kind of helped where they've owned their own brokerage account on Robinhood or something. And I'm like, can't give you financial advice, but I can like steer you in the right direction and show you videos and stuff that you need to learn more, so that you can go ahead and be ahead of kind of your class and be on the right direction moving forward.
Speaking about a recession or a stock market crash, with your portfolio and your knowledge, how will you react in a scenario of a stock market crash, maybe like a 3 to 5 year, where the market does absolutely nothing, it's in the red and it's just trading sideways? So how will you react in that scenario?
Probably a lot better than if I was, all in on 50 plus. If my portfolio yield was 35, 40%, like I've seen some people, and, I think it's working for them now. But if my portfolio yield was that high, I would probably panic, because I don't know if I would ever be able to recover my personal portfolio. If I track it, I don't know if it would ever get back to new highs, because I'm just catching a falling knife. But where my portfolio is right now, I think I'd be fine. I actually am waiting for a downturn. I'm hoping I get a big smile on my face when the market goes down, because then I can go in and buy stuff cheaper. And, I still have a lot of years to be able to invest and hold some cash for a downturn. Whereas, 15, 20 years, I'm going to have less time. It might not make sense to hold cash and wait for a downturn, but where the market's just been up so much, I think, having maybe 3 to 5% cash, I don't think there's anything wrong with that. Of course, the argument would be, well, that money's not invested. And so you're not going to be making the distributions, or you're not going to be getting the growth on that cash balance that you have. But, my argument is, if I'm having covered calls in my portfolio, I want to be able to dollar cost average down on it, because I don't want to see all red across my overview of everything, where my yield is, 15%, but my yield on cost drops to 12 because the portfolio can't sustain itself. And that would probably happen a lot faster if I had a higher yield. But I'm waiting for this recession, man. I mean, I'm waiting for it. I have not lived through anything over, 33% on the NASDAQ. That was in 2022. And, April was great. I added to it. I think honestly, I'm happiest right now when the market's down. And so the market keeps going up. I'm like, well, I guess I'm not buying any more covered calls today. I'm going to have to wait. And so, but sometimes like my cash balance gets above kind of the 5% that I want, and I go in and buy stuff. But yeah, no, I just don't have enough risk in my portfolio to where I think that it wouldn't be able to recover. And I'm like, oh, my retirement's doomed, and, panic sell out of there and lock in those losses and stuff like that. So
with your portfolio size, do you feel like you are financially in the right spot for your age? Do you feel behind, ahead, or just exactly where you want to be?
yeah, so when I was, watching a lot of the content from the Money Guy show, which is, to me a much kind of younger, fresher version of Dave Ramsey, which I think his stuff is very outdated, and he was one of the YouTubers, the YouTube videos I was watching was him, but I got really like bored of his stuff quick because it just didn't make any sense to me. The Money Guy show had so many different charts, and I kind of have them up kind of on my computer where I can view them, but it shows, how much you should have at each age group, and $1, how much $1 can turn into in each age group. And, right now it actually seems like I'm ahead, but, do the covered calls limit that a little bit, because it's based off of the S&P 500. And so some of the covered calls, if they don't perform quite as well because they lag a little bit, that could set me back a little bit. But right now, I think I'm in a good spot. I want to be able to keep moving forward and stay in a good spot. So I don't want to, run into a situation where I stop investing, or I, feel like I don't want to do it anymore. I lose interest, which will never happen. But right now, my distributions are where I want them to be. I do want to grow them, and then the portfolio balances as well, because again, with the covered calls, I think that's going to allow me to not need, the super high portfolio balanced in order to retire. And so, where I would be probably struggling, like, oh, I need, almost $900,000 more dollars. Like now I need less, and kind of the goal is more attainable and achievable because of the covered calls. And, that's one of the big reasons why I own them, is because of kind of the, attainability of them. I think, right now I'm in a good spot, and I'm going to hopefully, I may even be in a better spot, if there's a crash coming up and I really just dump a bunch of money in there and dip into my cash reserves and my savings, and I load up. I might have a different conversation and say I'm great. I'm in a better spot. But right now, I think I'm in a good spot.
From a scale of 1 to 10, so 1 being the lowest amount of risk and then 10 being the highest amount of risk, what risk do you think that your portfolio is taking on right now?
I would say probably about a 3. It's pretty low. I think the biggest risk is the covered calls, because they're newer. Everything else that I own is conservative, has a super long track record, and over time, that may drop to a 1, because eventually these covered calls, as long as they perform well, they will have a 10-year track record, and it'll be much easier to kind of screen them and kind of filter out the ones that underperform and it really could really hold the portfolio back. And so for me, I would say right now it's pretty low, about a 3.
What's one ETF that you would buy and hold forever if you could only choose one in your portfolio? And even let's throw in like one individual stock if you had to buy one forever.
It would be GPIQ. It's my favorite. It has, a yield that's kind of a little bit less than the long-term average of the Nasdaq. So I think that it can continue to go up. It really doesn't capture too much of the upside. It's getting like 75+% of the upside, I've noticed. And so I think that one, where I can get kind of the returns of the Nasdaq in the form of distributions without seeing the declines that you have. I think GPIQ is a really good one, and I think it's kind of my favorite covered call right now until I can get more. Yeah, so one stock I would probably say, Home Depot. Home Depot is just something that I don't think can ever be, like, it's got such a good moat behind it that I don't think Home Depot can ever be beat. I think people are going to need to go there as long as the world keeps happening. They're just so good, and there's, competitors like Lowe's, but I don't think they'll ever compare to Home Depot, and I think, I would be okay owning a Home Depot stock. They have like a 2% dividend yield, so you get the dividends and the dividend growth there. I don't know if they've cut the dividend or not before. I don't think they have, but they're just a really strong company, and I don't like. If I had to pick a company that I think would be able to handle really tough times, it would be something like a Home Depot.
Lastly, for those who are watching your interview and maybe are in your situation, or maybe even like want some motivation on how you got to where you're at, or just maybe they don't have like the largest portfolio or even a lot of money to invest in the stock market, but you made it all happen to have a 6-figure plus ETF portfolio.
Save as much as you can, and definitely try to stay motivated even if you're on a lower income. And that's why I'm trying to kind of get myself out there. I've joined Blossom. I want to show kind of people that just working a simple food service job, you can save, invest, and have a 6-figure portfolio, even starting with nothing, by just kind of having the right mindset and, eventually maybe, get to that 500, maybe even $1 million portfolio, especially, if you're not overselling your portfolio and it just continues to grow over time. But, I see a lot of people that, kind of discourage, saying it can't be done if you don't make 6 figures or you don't have that kind of blue collar job. And it's very discouraging because, again, I don't see a lot of people in the food service really talk about this stuff. It's very uncommon. And even outside of that, I think people don't. And so it's really kind of just, trying to motivate people and show that like, it's harder, but it can be done. And so I'm going to continue to try to, kind of get myself out there, kind of prove the system wrong and the kind of the naysayers about, you can't do it if you only make, if you make less than 50K or if you make 50K, it's just, it can't be done. You have to have, you have to have a wealthy family. You have to come from this. You have to do this. You have to do that. And I think it's, it's quite discouraging. A lot of the content I've seen, out there in the world that really says you need to have a lot of money or you need to, have a decent amount of money to start with and go all in on margin. It's not true. And, I still have a long ways to go, but also I have, I'm 33. So, I could have a really big portfolio, in the future. And I think that I will, because I think my strategy, I stand behind my strategy. I kind of like my own fund manager for myself. And, I try to keep the turnover low, and I think that, I'm going to keep pushing forward, and I believe it's going to work out. And so, I don't see a lot of people kind of really, promoting, lower income, can make this work, can make it happen. There's definitely lifestyle creep, and, some people might be in different, harder situations. But I think, for the ones that just are not doing it because they don't have knowledge or because they don't have someone behind them to kind of really show them what to do with the money that they are bringing in. I think, again, just putting away $5 or $10, a month or, to start, and that can still grow and that can still turn into more than you had if you can set it and forget it. But, I think for sure it's, really about the motivation. And so I'm trying to, show that, with lower income, you can get a 6-figure plus portfolio at a relatively young age, starting with 0.
Thank you so much, Chris, for talking about your investing journey, your investing story. Now, investors, you guys can follow Chris on Blossom and see his entire portfolio and follow his journey more. Now, if you guys like this video, please give it a like because this cute puppy did. And don't forget to check out our last interview right here on your screen. And once again, this content is for educational and informational purposes only. We are not financial advisors. Do your own research, and we will see you guys on the next one.